If you own a business and you've ever thought about selling it, this is the only video you need to watch. I'm an investment banker. I spent over 10 years on Wall Street. I've closed over $20 billion in transactions. Every single potential strategic angle you could have for making a company more valuable, sellable, and attractive to a buyer, I've done that many times over. Whatever stage you're in, I'm going to give you every single piece you need to know on this one very specific topic: selling your company and exiting successfully. Things like when to sell, how to know you're ready, what your business is actually worth, how to get it prepared, how to find the right buyer, and ultimately what happens during the deal and what you need to do after you sign the actual closing documents so you can walk away with a successful outcome and transaction. This is a very complicated process. I've spent my entire career inside of it, and I've broken down all of these concepts into chapters so you can actually follow the whole thing in one place. Whether you're 5 years out from selling or you're 5 months out, make sure you bookmark this video because we're going to be covering every single step in that process right now. The first decision you need to make is actually the simplest one to make, but it's also one of the easiest ones to get wrong. Do you actually want to sell your company, and do you know when you want to sell it? If you already know, if you're at the point of saying, hey, it's time for me to exit, I'm ready, that's perfect. That is a clean entrance into the process. It's your company, it's your business, and ultimately it comes down to your own personal goals for when you want to start the process, when you want to exit, and how does that fit into your personal goals in your personal life. If you're unsure, I would encourage you to look at the market and see if buyers are showing real demand right now for companies like yours. That is a reason to really think hard and say, should I sell while the demand is there and it's active and you don't miss that window? Here's the one thing you also need to be honest about yourself. There's a lot of business owners who won't say this out loud. If you know that you can't grow your company as fast as it should really grow, like there's so much potential, this is actually a great time to sell it because somebody with a bigger balance sheet can come into your business and grow it, provide you your value today, let you take chips off the table, and potentially even let you roll some of your ownership as upside into the equity of that business while it continues to grow on the back end with their capital. However, you cannot skip this step in the deciding process. If you go into the process with uncertainty, the buyers will feel it and they will stop taking you seriously. You'll burn your own credibility so that when you actually do want to sell and you're more serious, now you're starting from a position of weakness because now you have to go back to those same buyers and reestablish yourself and explain why you're actually certain now. Your level of certainty in the sale process will directly drive the level of certainty you're going to get in your offers to sell your company. If you're not certain, you're most likely going to get lukewarm bids that are not real, and then you're forced into a lukewarm decision-making process, which is not going to get you the outcome that you want. One of the challenges that I hear from business owners all the time when they go into this and they are lukewarm is that they end up getting really deep and really entangled with one particular buyer. They thought they were going to get a great offer, and then that offer falls apart and it wasn't as strong as it should be, and now all of a sudden they're stuck. They've wasted a significant amount of time, significant amount of resources, they've lost their optionality, and they have to start the whole process over from scratch. This is an intense process. It will wear you out if you don't do it properly, and you really do not want to run it twice. When you look at it, selling a business is also going to be an emotional journey. It's not just tactical in business. You've spent maybe 10, 15, 20 years building an incredibly valuable company, and selling it is a process and a journey where at the end of that journey, you're going to be parting ways with this business and exiting. You cannot let the emotional factors drive your decision making and the outcome in this process, because whoever buys this company, the right counterparty, is not going to be seeing the business the same way you do from an emotional perspective. If one day you're on board and ready to sell and the next day all of a sudden you're not, and you keep going back and forth, that's not going to end well for you inside of this process. You need to get your emotions under control way before you enter the process. Decide what you actually want and then move forward properly. If something changes during the process, you're thinking logically and rationally, and it makes sense to pivot, then of course you can change direction. You can stop the sale process, you can move. Just don't let the emotions be the primary driver of the decision making. The other item that I want to highlight is the right time to start building buyer relationships is important as well. Do that before you're ready to sell. We help clients do this all the time. For example, if you're not quite ready to sell, we'll help you get introduced to private equity firms and buyers in advance in a very informal, low pressure way. All you have to be able to say is, I do want to entertain a sale at some point, and I'm open to the possibility. I want to introduce myself and I want to build a dialogue. You're building that dialogue with buyers ahead of a sale process. That way, you already have the warm relationships when the time to sell comes. You're not saying to these buyers, hey, I might sell, I might not, give me an offer, tell me what I'm worth. You're simply saying, at some point, I want to sell this company and I'd love to build a relationship with the right investors and understand how you would approach my company. We help our clients do that all the time, and it's very strategic and very tactful. Now that you know you want to sell, every business owner will ask me the next question exactly the same in this order. What is my company worth? What is it going to get for in a sale? And the first thing I'll tell you is the thing that most people misunderstand about selling a business. Valuation is not a formula. It's not, hey, here's my revenue, here's my profit, now give me a number. It is very flexible and very fluid, and you can actually change that number pretty meaningfully, which is a benefit to you. The same company can be worth more to a strategic buyer than a financial private equity buyer. And another huge factor is how you actually position the business. If you position it correctly, if you prepare prepare it, if you market it properly, and you frame the opportunity to the right group of buyers, that is going to drive the valuation number up or down. So the fact that it's fluid is a benefit because you can make it higher. At a high level, you value a normal sized company off of its EBITDA, which is earnings before interest, taxes, depreciation, and amortization. EBITDA is meant to be a proxy for the profitability and the cash generation capabilities of the business, the free cash flow of the business. Then you apply a valuation multiple to that EBITDA. For example, a smaller business may typically trade around 4 to 6 times EBITDA, and that's somewhere in a $1 to $3 million EBITDA range for that business of profitability. A bigger business, 5, 10, 15, $20 million EBITDA could be 6 to 10 times, and a very large corporation company or tech or SaaS business could be 10 plus because of the growth that's built into those businesses. It really varies based on the industry, the type of company, the growth profile, the dynamics of the business. There's a lot of factors that go into a valuation multiple. If you see a reference point online where somebody got 15 times EBITDA multiples for their business, that does not mean you're necessarily going to get 15 times. And on the flip side, if somebody tells you, hey, your company can only be sold for 3 or 4 times EBITDA valuation, and that feels low to you, the reality is that you might be able to sell for a lot more than that. So don't let some high-level ambiguous data point out there skew your perception in either direction. The traditional companies that sell to private equity, they tend to land somewhere in that 4 to 8 times EBITDA valuation range. All of that is really impacted by the capital markets, how the economy is performing, what's going on inside your specific industry and your sector. A lot of valuation factors drive that. One of the natural questions that comes next is, how do you push your EBITDA multiple higher? Well, there are a few things that you can control. The more recurring revenue and contracts you have, that will obviously help your business. A diversified customer base will help too. 100 customers is worth way more than 5. The size of the business matters because generally the bigger the business is, the more valuable it will be. And these growth dynamics matter. So if you've been growing for 20, 30% a year for the last couple of years instead of 2 or 3%, that will also have a significant impact on your valuation. And then you have the management team and the operations of the business. The better positioned your company is with respect to having limited to no owner dependency or owner risk, that's going to help you increase the valuation as well. I want you to really sit with all of these, especially this last one, because that's the one where a lot of people underestimate it. If you yourself are the company, if you've been running everything and you're deeply involved, that obviously helped the business grow and succeed since you've been running it. However, it can also hurt you in the valuation if there's no team in place that could actually replace you and there's no SOPs, no framework for how the business continues to operate and exist without you in it. But what's going to happen then is that the buyer is either going to walk away from the business because it's too top heavy dependent on you, or they're going to reduce the value of the transaction or push a lot of the value into an earnout or back-end contingencies in order to keep you around and stabilizing the business. If you've delegated to a team, you're more strategy in your oversight, and the business can continue running without you, you're in a much better position. It's much less of a problem for the buyer, and it will make your company more valuable when you go to exit it. And one of the common mistakes I see in a transaction, let's say a business owner gets a theoretical valuation done on their business and it generates a number in their head. That number then becomes the benchmark that is stuck in their mental model, and when they go out to run a sale process, that's the only number that they can see. They're only targeting this number, this outcome, this is what I want, and they stop taking feedback from the market. My advice to you on this, couplefold. One, don't lock into that one number. First of all, identify whether you even want to sell and when you want to sell, and then identify from those things what is the best way to get the highest possible valuation. And you have to run the best process, and you have to understand that your company what it will be truly worth inside of that process. And the only people who can really tell you that are the people who are going to buy your company. Only a buyer can tell you what your company's worth because they're the customers for your business. You might get to the end of this process and you're going to confirm one of two things. This value lines up with my expectations. This is great. I'm going to get an amazing outcome and I'm happy with it. I'm going to sell. Or this valuation doesn't make sense. It does not line up and I don't want to sell. Either way is totally fine, but don't jeopardize the process because in your mind, you've anchored to a particular number. The process will tell you that your company is worth what your company is worth, and you'll get feedback on what to improve. Let me share with you one example of a business owner who recently faced this exact challenge, and in hindsight, they regretted it because I was speaking with this owner and they received an offer of almost $50 million for their company about a year ago. And at the time, they thought it was a really good offer, but it just wasn't quite the hard to turn down number. It just wasn't good enough so that they ultimately held out and did not sell the business. And then all of a sudden, their industry got hit with a major regulatory issue. And unfortunately today, as I was speaking to this business owner, they're trying to sell their business. They've been trying to generate the interest for acquirers to buy it, but they're getting offers in the $10 to $15 million range. And they're not sure if they're ever going to be able to get back to where they were. And at this point, 50 or even 25 million they would be happy with. In hindsight, they deeply regret not executing on that offer when they knew that it was a good transaction. However, they were trying to get the best of the best and just literally squeeze out that last dollar out of the transaction. And the tricky thing is you don't know what's going to happen inside of your industry, or somebody might have a major issue, and you're taking all of that risk when you delay a transaction. So I often say one in the hand is better than the bush when it comes to selling your company. If a deal is in the right zip code, if it's in the right zone, capitalizing on a sale transaction usually beats holding out because you're taking all of that future uncertain cash flow in your your business, you're pulling it forward and you're crystallizing the value today. That's what happens when you sell. You're taking a bunch of uncertain future value and making it certain in your pockets today. But you can only make that call once you have real feedback and real value indicators from the market based on a real transaction that you can actually execute on. You cannot make up that decision based off of a number in your head or a theoretical sale transaction or a deal. If you're already running your own company's numbers in your head right now, that is the right instinct you have. You're trying to understand, what is my company worth? What could it be sold for? And whether I should think about selling it right now or not. And that's exactly the right moment to talk to somebody who does this for a living well before you're in the room where you have to sell or you're forced to sell. If that's a conversation that you would like to have, I'm opening up complimentary consultation calls with me where we'll dig into your exact exit strategy and you can have a real conversation about your company, what it could be worth, and how an exit would actually work for your particular business and what the process will look like. If this video is the map for laying out the territory for sale, that call is where we're going to look at your specific situation, see where you are in that map and in that process, and how you would actually navigate it. The link for that call is going to be in the description down below. Book that call and we'll strategize about your exit. Let's get back to the roadmap in the video. Now that you know you want to sell and you also understand what drives the value in the company, the next step is actually getting the company ready for sale. And I'm going to split this preparation phase in 2 different phases. Phase 1 is operational. This is the work and the processes that actually make your company sellable. This part is on you as a business owner, although we can help you and we can walk you through exactly what these pieces are. We do also offer consulting services around pre-exit preparation. However, the primary focus here is going to be on your books and records, your financials, your operations, your legal documentation, really just making sure you have all the steps and the infrastructure in place to be able to actually exit this business and transfer it to somebody else as an entity, as a going concern entity. All of it needs to be clean, proper, and in place before you go to sell. The more you can document it, the more you can make it clear, the better your valuation is going to be. You ultimately want to understand also operationally, how are your sales team structured? How is your marketing structured? What gaps exist there? What improvements can happen? How diversified are you operationally? Do your customer relationships actually exist on paper as real contracts, or are they just verbal agreements you have with your customers? Ideally, if you've scaled your company properly and you've built the foundation along the way, a lot of this is probably already established. However, if you've been building your company at a rapid pace and you've been catching up and it's mostly happened in real time without the organizational effort, you may need some time to clean this part up and actually organize it properly. One of the most common things that I find missing is that businesses are just not organized for this, not because they don't have access to the resources, but they've never actually looked at their company the way a buyer would. Nobody has looked in and said, hey, here's what a third party would look at to evaluate the business. The company has just been simply operating as a company. They've been closing sales, they've been fulfilling orders, they've been scaling, they've been putting marketing out there, and no effort has really gone into like strategically package the business and set it up for an exit. As a result, there's no way to transfer the knowledge and the documentation required to run the company without the people that have owned the company and ran it. You don't understand what risks and mitigation factors are inside the business that would make it hard to sell. You need to be able to walk through every single angle, every single function, and literally ask, could somebody else come in, understand this, and continue to run the business? What concerns would they have about this particular function as you go through the entire company? Phase 2 is actually selling the company, and this is where we come in formally as your investment banker and advisor for the business. We're going to need to understand everything going on inside of the company, how the company has performed historically, how you expect it to perform going forward, how strong it is financially, operationally, what are the customer profiles like, what does demand look like for your business, how does industry perform, who runs the business on a day-to-day basis, what's the business model, what are the unit economics, what are the real opportunities in the business, what are the weaknesses, what are the strengths. Everything from A to Z that we would need to be able to properly market the business is going to get built out in this phase. We're going to analyze it, we're going to diligence it, we're going to package it before we ever talk to a buyer. And you're going to hear a lot of questions from us. We are going to grill you and diligence your company in a very collaborative, friendly way in order to understand every single lever inside of your business so that when you're ready to sell, we can actually represent the business properly to the market and extract the most amount of value because it's so clear what it is. You might hear things like, hey, it's going to take 12 months to 24 months to actually get ready to sell. It's a really long window and you might need some time to clean things up in the front, maybe 3 to 6 months. It's of course company and situation dependent. And then the actual selling preparation phase after that, if all your infrastructure is ready, is another 2 to 3 months. And then you can go to market and sell the business from there. Let me show you what a really well-prepared company looks like and some of the characteristics that drove a really strong valuation exit. This is an equipment rental business, the same one I'm going to refer back to later. It did around $40 million in EBITDA annually, and they came to us with an offer in hand, and they wanted us to help sell their company and make sure they got the best valuation and they weren't selling themselves short. We told them, okay, let us run our standard diligence process where we understand everything about the company, how it's set up, how it works, what the financials are, what it looks like, who runs the operations, all of these pieces. And the company itself was very well set up from an enterprise perspective. Every single store and location ran on its own. The management team sat at the top, basically monitoring everything and just watching the strategy of the business and giving guidance to the organization. The family was involved in the business and in strategy, but they were no longer the day-to-day operational people. And their financial systems were set up very well for a company of that size. You could literally pull store level profitability and consolidate the entire portfolio in minutes. You could literally cut the data up hundreds of different ways, all in one easy to access platform with records. Super valuable. It makes it very easy from a buyer and a seller perspective to be able to communicate confidence to the counterparty, where you can literally pull revenue mix, profitability in minutes, track it over a historical period of time. It gives a lot of credence to the valuations. Big part of why they got such a strong valuation and a clean exit, where we were able to sell them for $280 million instead of $250. We created $30 million of value in a solid business that you could look into and say, hey, this is good. I can underwrite this. There's a lot of granularity and we can improve the valuation as a result when we go talk to buyers. You're really going to want to get all of this stuff in place in one way or another. Now, obviously, that's something we do with a lot of our clients well before they're ready to sell. We call that a pre-exit audit. This is where we go into your business and say, hey, let us audit your company the same way we would if we were going to sell it, and give you a report based on your financials, your customers, and your operations. These are all the opportunities that I see in your business, and here are all the risks that we're seeing. You could fix all of these ahead of time so that you actually improve how sellable your company is. You increase the valuation of your company. You can reduce the gaps in the time that you'll need before the right moment to actually sell is. This only works because I've spent such a long time working with buyers, pitching companies, and working with sellers and private equity. I can spot the gaps incredibly fast, and I can help you identify the highest leverage points that a private equity firm or a buyer is going to look for when they want to acquire your company. If that's interesting, I'll help you present the business in its best possible light for the highest valuation. Obviously, I cover a lot here. That pre-exit audit will give you everything you need to change the company, improve the operations, address the key risks, and flag anything that needs to be changed well before a buyer is going to take a look or ever finds out about these issues. Say you're ready to sell, who's actually going to buy your company? And that's the next stage of the process, because the type of buyer is going to change everything about your outcome and your sale process. So let's start with the strategic buyers. These are companies that are already in your industry, and on the strategic deals that I've worked on, these buyers will acquire other companies and operators across the country and typically roll them up. A strategic buyer, for the most part, can provide the most value for your company relative to a financial buyer, because they can get real strategic benefits out of acquiring you above and beyond just the financial returns of investing in your company. They get, for example, direct access to your customers to cross-sell their products, greater geographic density, the ability to consolidate costs between the two companies and increase the profitability for both enterprises. There are a variety of reasons why they would want to buy your company. Those are strategic reasons to acquire your business. On the other side of the table, you have financial buyers, and these are different players. These are the private equity firms and family offices. Their entire business model is to buy companies like yours, make them better, and eventually exit and sell them. They are highly sophisticated, they move fast, and there is a massive amount of capital committed to acquiring companies in almost every single industry you could possibly think of. It does not matter what industry your company is in. I promise you, private equity is in that industry, and they have invested hundreds of millions of dollars, if not billions. They're open to acquiring your company no matter what niche you're in. If you want to sell to private equity, there's very likely a firm that's already active in your space that owns a portfolio company that's similar to your business. I also want to clear something about private equity, because the way you approach them really matters. Private equity has this perception they're the villain, or that it's a really bad outcome for a company. That's just quite frankly not true. What actually hurts a business owner when they sell to private equity is not private equity itself. It's more about not understanding how you deal with them and how you navigate that deal. If you believe private equity is a bunch of monsters, that comes from a very limited understanding of what they really do. Private equity is a growth accelerator for almost any business in any industry. They are a phenomenal source of capital and a partnership. They improve businesses, they grow margins, they grow revenue, and they expand companies. Of course, you need the right private equity partner. There are firms that don't do well, but the right well-capitalized firm is genuinely a growth driver and engine for a good company. There's another group that's actually the best of both worlds, and that's the strategic private equity buyer. This is a private equity firm that already owns a company in your industry. They've got the capital, they want to grow, and they're already in your space. So for them, buying your business and your company is both a strategic transaction and a financial one. And that's often the single strongest buyer there is, because they have the most amount of incentive to be able to acquire acquire a business. They have the capital already committed, and they have the most experience in acquiring companies, so they can move very quickly. Beyond that, you also have family offices and hedge funds, which are much more bespoke in special situations, and high net worth individuals who could also potentially be a good fit for smaller companies, but are usually not your best buyer from an execution and timeline perspective. The right type of buyer really depends on the goal of your exit, the speed and certainty of execution you want, as well as the synergies that you could potentially offer a strategic buyer. All of that is going to get defined and identified company by company and situation by situation. That's exactly what your investment banker will help you do when you're working with them to sell your company. They identify the right pool of buyers to go after, and they tailor the company to that buyer's specific needs. They can actually deliver you the best value possible when you sell to that group of buyers. Let me show you some more proof of why this matters so much and how much of an impact it could actually have when you sell your company. The equipment rental business that I mentioned earlier, the family that owned it had an offer from a financial group at $250 million. They were going to take that offer. Before they came to us, we stopped them and told them, hey, this is not how you sell a company. You don't just sell it to the first person who gave you an offer, even if it's $250 million. Let us help you find the right buyer and identify the most strategic acquisition partner in the space. While we were engaged, we went and identified a strategic buyer for them, a much larger company already in the equipment rental space. For that business, it made a lot of sense to buy this company from our client, the family, and roll up all of these assets into their company and their corporation. We were also able to put a lot of pressure on that buyer to preemptively come in and acquire the business without having us having to go run a full long-form auction process. It was the same exact business that was sold. There was no change in the revenue or the EBITDA before or after we came in. We strategically identified a different buyer pool that led to a different buyer, and we ran a tactical sale process that resulted in a $30 million increase in the enterprise value of the company. Now we're going to move into the part of the process a lot of business owners have never actually experienced or even seen because they've never sold a company before. This is the real deal-making stage of the transaction. Everything up to this point was simply the preparation and the marketing to get the company ready. This is where we're going to work on the LOI, the diligence, the negotiation, and the actual structuring of the deal. Offers at this stage are going to come in two different phases. First, you're going to get an indication of interest, an IOI. It's a non-binding letter that basically says, hey, here's roughly where we, the buyer, would be on an initial read of your business to acquire it based on some preliminary information. Here's our valuation. Here are our terms. Here's our structure. As a seller, you want to make sure you solicit a number of buyers to submit these IOIs so that you actually get a real feel for the market. Then you compare those terms, find the best bids across all of them, and give those buyers more information and resources to actually firm up their IOI and convert it into a better LOI, a letter of intent. What you're telling them is, hey, you're in the right zip code. We just need you to improve these terms to be the best bidder, and then give us an LOI so that we can actually execute on it and go exclusive to sell the company to you. Once you receive that LOI, you have to understand it's binding in one really important way. The buyer who signs it is going to want exclusivity from the seller. They want the right to do the diligence and finalize the terms of the deal in order to acquire your business with nobody else competing at the table to acquire it. When you enter into an LOI, it should represent about 90-95% of the final transaction from the LOI stage to closing. There are no big retrades on value, terms, or structure as long as you built the process properly and vetted the key issues going into the deal. When you read one in an LOI, you need to understand exactly what's being proposed in the document. How does the value flow from the headline price down to your actual take-home price? What will the buyer require from you as the seller to stay on, and the level of diligence and information they still need to be able to get comfortable to close the deal? How much of the transaction is cash versus equity? How is the buyer going to fund the deal, and how committed is that funding, at the moment? Because anybody could write a binding piece of paper, but if the buyer can't actually close and fund the transaction, you do not want to enter into exclusivity with them, because now you've foreclosed all your options to sell the company while they hold a free option to go find their financing, and they can just look at all the work inside of your company and diligence it all day long. Concurrent to this, the diligence process is continuing. Obviously, in the background, you're going to be giving information to buyers in increasing orders of disclosure. In the beginning, you'll provide a certain amount of information, and as you get further along, based on that party's interest level, you're going to disclose more and more to them to be able to finally get them comfortable enough to close. A little bit in the beginning, more at the end. One of the big mistakes business owners will make when they sell is that they try to hide something because they've decided that on their own, it's not a big deal. The buyer doesn't need to know about this. If they look at it, they might hurt the valuation and worry them. The problem with that is the buyer will find whatever you're hiding. So do not hide anything. Be incredibly transparent with your investment banker. Tell them everything about the company, the good, the bad, the ugly, because the banker will help you find the right way to frame any issue and deliver it to the buyer in a way that it doesn't hurt the deal or take it off track. Because what's going to happen is if you sign exclusivity and then a lawsuit that you never mentioned surfaces a week before closing, that deal is most likely not going to close. And you've changed the entire dynamic of the deal because now the buyer has all the leverage to renegotiate and retrade simply because you did not control the process properly. Let me share another real example with you, this time from the buyer's perspective. I was advising a US-based company. This company is worth around $5 billion. It's a private family-owned business. They were a client of ours. We were advising them on acquiring another company. The target company that we were acquiring was a division of a larger company. This division had a major litigation and a product recall inside of their business that they did not disclose to us, the buyers, when we were well into the diligence process in the near final stages of acquiring the business. Once we realized that this was happening and they hadn't disclosed it, because buyers will, we renegotiated the deal. We required the seller to carve that asset out and we did not buy it. The seller ended up having to absorb the valuation impact of that carve out themselves and didn't sell a portion of the business. And ultimately, it was a good move for my client, the buyer, and it was a difficult outcome for the seller who simply was not organized enough to really get ahead of it and frame it for us properly. Maybe if they had presented us to it the right way, we might have accepted it, but they got caught on their back foot and they had to take a valuation hit because of it. If you don't know what you're doing running this process and you try to run the process haphazardly, you will lose a significant amount of value and leverage when it comes to the transaction and ultimately closing it. Now, the next step from here is really all about negotiations. And the more competitive pressure you have here, where every single buyer knows that there are other buyers at the table, the more leverage you're going to have throughout the process. The single biggest dynamic I would say in any deal comes down to this simple fact. Who has the most leverage to walk away from the transaction and who needs the deal the most? An 80-year-old seller who has to sell his company because of his health issues is in a completely different position than a healthy 45-year-old who maybe he wants to go start something new. He has all the flexibility in the world. He's making a good income and earnings from the business and he does not have to sell today. He may want to sell, but he does not have to. Those are very different dynamics. And there are a lot of strategic ways to build leverage on the seller side, which is exactly why you want a banker with real experience who's transacted these businesses and why it matters so much. They can do that. They can push the deal the right way. The next stage is all about the deal structure, and there's a few different ways it can go. You could have your deal be all cash. You could have your deal be cash plus equity. You could have the deal be cash plus equity plus earnout. And you could also have a minority equity transaction. There's a lot of contingencies that could be built into escrows, working capital, reserves, things of that nature that reduce your take home from the headline number. A lot of nuances here, but the biggest thing I want you to understand is your headline price does not mean anything on its own. You can get a $100 million valuation, $100 million offer, but if 90% of it is in an earnout, it's deferred compensation and rollover equity, that's not a good outcome for you. You basically sold the business for very little cash and you're taking a lot of risk on the back end because you don't know who the operator is. Don't get excited about a headline number without fully understanding it and evaluating it. You need to understand the nuances of the transaction in order to make sure that it's actually a good deal for you on the back end. Now, here's something that's going to surprise you. Closing and post-closing are actually the easiest parts of the entire transaction. By the time you get to this point in the deal, the very last piece, the hard work is basically done. Closing is like the very end. It's a very simple process. Everybody has their final definitive transaction documents. You might have a stock purchase agreement if it's an equity deal, or you'll have an asset purchase agreement if it's an asset deal. Everyone signs the documents and you have a closing call. And then you prepare a document called a funds flow, which identifies how much the buyer is paying in funding, where they're sending the capital to, and who all gets distributions out of that transaction. Everyone will get their share. The banker gets their success fee. The lawyers will get their fees. Everyone nets out the expenses, and the seller gets one wire and one check basically at the end that shows their net funds from that transaction. After that, there's a few things the seller needs to manage to take the transaction all the way through full close. Taxes are a big one. You should start thinking about that early as well. We can refer you to the right people to help you manage your tax liability in a really smart way. What a lot of business owners will misunderstand and get wrong about taxes is if you wait, you know there's a transaction coming, just go ahead and talk to the professionals proactively. Don't wait till the very last minute and strategize a little bit. And you also don't want taxes to stop you from a good deal because taxes will be here today. They will also be here tomorrow. You can't really get rid of them. There are ways to structure the deal correctly to preserve net proceeds and defer tax obligations. Make sure you don't kill a great exit over taxes because you may not get the opportunity to have that exit again. The other item to manage is after closing is your continuing obligations to the company. Do you have an earnout? Do you have equity that you need to manage? Is there an escrow that's being held with proceeds that will get released to you over time based on certain conditions in the company? You need to stay on top of that and track all of that because that's real value that's locked inside of the business that will still come to you over time and you want to realize it. Make sure you have a full understanding of your obligations. Work with your banker to map out exactly what you need to do to be able to close out on the back end and what you need to monitor. Now you've got the whole map. But one thing that I want to share that was central to how the value of your business actually gets improved and delivered, it was consistent throughout every single chapter that we just covered, and I want to make sure it's obvious to you. It's not the financials, it's not the mechanics, it's not the spreadsheets and the numbers. It is all driven by the person that is running the sale process for you to actually sell your company and monetize it. And let me walk you through one more example of just how important that is. This is an extreme example, so obviously results like this are not indicative of future results. Remington Outdoor Company is one of the largest and oldest firearms companies in America, and they had a single buyer offer on the table for approximately $60 million. They were a client of ours. We had helped them through multiple transactions, and at the time they came to us, they said, hey, here's where we're at. We're looking at an exit, and this is the offer we have on the table. What should we do with it? And our first piece of advice that we told them is the opposite of what you might expect with the advice. We told them to reject that single bid and instead let us run a full competitive process so that we can actually maximize the value of their exit. We analyzed every single division inside of the company, the ammunitions division, the firearms division, all the little brands that were inside of the company. And we basically broke the company apart and said, hey, who would be the best buyer for each one of these pieces, this asset versus this asset? Then we ran a marketing process where we connected with over 350 buyers, private equity firms, strategics, to find the right home for each of these assets. And when we found those buyers, we made them compete for the opportunity to acquire the company. So every time one buyer raised their price, we would go to the next group in that pool and say, hey, this asset is going to get sold, and currently you're not in the right zip code of value anymore. We need you to increase your bid and give us a reason why we should sell this company to you as opposed to one of our other buyers. And we basically pulled the absolute maximum value out of that company, and ultimately we took it from approximately a $60 million offer that they had when they came to us to $160 million of enterprise value. Same exact company, same exact assets, nothing changed financially. One bid, it started at 60 million, and the right process landed the company at over $160 million of value. That really is the entire point of this video summarized in one situation. The exit process is extremely complicated, it is very bespoke, and it's very nuanced. However, when you run it properly from start to finish, you're going to understand mechanically how it works and how you can drive value in the sale of your business. But the actual implementation of it, going from, hey, here's what I think I should sell for, all the way to I got the best value, the best price, and the best process to actually sell my company, that is where you need the right person to run that sale process with you. So that's the full exit process from start to finish, all in one place. Knowing and understanding the stages of a sale when everything goes right and is on track is one thing. Making sure you avoid the mistakes along the way, the ones that could jeopardize your deal and dramatically reduce the value of your company, is an entirely different beast. I want you to go ahead and watch this video right here next, where I break down the biggest mistakes business owners make when they go to sell their companies, and the kind of mistakes that will end up costing you value and optionality, and exactly how you can prevent them so that none of those ever happen to you. And if you're also seriously considering an exit, you want to understand what your options look like, there's a link down below in the description to book a complimentary consultation call with me where we'll help you plan out your exit. Looking forward to it.